Hey all, welcome to ShareTreck where science meets investments, and I'm your host Raj. Friends, it's a beautiful weekend, and today we are pulling back the curtain on what may be one of the biggest illusions in the US markets this year, the shocking fall of the US dollar and how it's masking the real weakness in American stocks. If you're wondering why equities seem to be climbing while the economy slows and the Fed prepares to cut rates, well, it turns out the dollar may be doing the heavy lifting, and the concern should be for every international investor who is investing into the United States. We're going to explore this today. Let's get started. Welcome back, friends. The US dollar index, or DXY, has dropped by more than 10% in the first half of 2025, the worst 6-month performance since 1973. What triggered this? Well, the US money supply hit a staggering $21.9 trillion by May 2025, which was a historic surge. Simultaneously, ballooning federal deficits and record national debt have eroded global trust in the dollar. Investors now question whether the US dollar is still a true safe haven. To put this in perspective, we haven't seen a dollar breakdown like this in over 50 years, and it's not happening in isolation. A falling dollar often lifts asset prices, and that's exactly what I think we are seeing in the tech stocks, crypto, and commodities. I'd like you guys to give me your feedback in the comment section because I value your inputs. I think that risk assets are surging, but this isn't necessarily due to improving fundamentals. It's because in dollar terms, everything looks more expensive. This is where the illusion begins. Even foreign investment flows are skewing US stock valuations. In other words, the stock market's resilience might just be the dollar's weakness playing tricks on the charts. Here's the concern. While valuations go up, fundamentals are going down. US manufacturing indices are contradicting. Consumer confidence is sliding. Real GDP growth projections are being revised downwards. And you have heard the recent news about Microsoft letting go of a whole lot of employees. Likewise with Meta, which also reduced the staff numbers. And we had the Doge cuts as well, even though it may not have been as potent as it was expected to be, but still there were a lot of cuts. So if you look at the overall situation, and I'm going to talk about these other aspects in a separate video, but we have to look at credit card delinquencies, mortgage delinquencies, and we have to look at bankruptcy filings. I'm doing a separate video on all of those things, but whatever I have seen so far seems to indicate a lot of softness in the overall economy. Under normal conditions, this would pull the stocks lower, but the falling dollar distorts everything. Even analysts are flagging this divergence. And remember, whenever I do my pre-market live streams, I have a reference always made to the bearish divergence that I see on both the stock market indices, NASDAQ as well as the S&P 500, which are the two things that we look at, and also the complacency of the market in terms of the VIX being so low and placid among all of these situations. So I think currency, the weakness of DXY is definitely masking a lot of the stock market weakness. As you can see, stocks are priced in a weakening currency, which inflates asset values and masks fragility. If you're investing based on price action alone, I think you're flying blind. And that's my suspicion. And that's why I have moved some of my US dollar funds into the Canadian dollar side for the time being. I think the Fed is expected to cut rates later this year as economic data deteriorates, which should be bearish for stock. But thanks to the dollar's fall, those cuts are interpreted as bullish. Meanwhile, global currencies are strengthening against the dollar. If you look at the DXY, it gives you an indication. The euro has gained nearly 8% in 6 months. The yen and yuan are also rallying as investors diversify out of dollar exposure. So if you're an international investor, US assets may not be as appealing or as cheap as they appear in dollar terms, especially when you try to sell them and take the money back into your domestic currency, as evidenced by the DXY. Here's what this means for different investors. For American retirees and savers, your purchasing power is eroding. Dollar-based assets may raise in nominal value, but your real returns, adjusted for inflation and currency weakness, are thinner than they seem. And for domestic equity investors, be cautious about interpreting the market rallies at face value. Weakness in the dollar can create a false sense of resilience in your portfolio. For foreign investors in the US market like myself, currency conversion works in your favor for now, but the longer the dollar declines, the more you are exposed to sudden volatility and repatriation risks. This is a structural shift, not a blip. And the next phase could include either a rebound in the US dollar or a sharp equity correction to realign with the fundamentals. Well, friends, those are my thoughts for this weekend, and I'd like to hear from you guys if I'm onto something. Thanks for watching this video, and if you have not yet subscribed, please subscribe, and also please press the like button to help the channel. And this brings me to an end of the video. I'll be back with the next video where I talk about the other fundamentals as well, and I'm also looking at autoimmune and a few other stocks that I want to talk about. Watch out for that very soon. Thanks and have a great day. Bye for now. Have a great weekend.